Money is the lifeblood of any business. Without money, it's a wrap. You can't do anything. Welcome back yet again to another segment of the Afrobiz Hustle 101 show. This is a home where we talk about anything and everything business, anything and everything hustle, anything and everything founders, business, small business, innovation, creativity. This is the channel. This is your home. Welcome. For those who are already subscribed to the channel, welcome back. And for those who are new to the channel, please don't hesitate to subscribe. And as well, hit the like button and notification button so that we can, give you all the updates whenever we launch a video. In the last segments, we talked about the business ideas to focus on. We talked about the fundamentals that you need to consider when you're doing business. And now today, we're going to put a spotlight on the 7 ways you can raise capital for your startup hustle. Before we go into that, it's important that we look at some of the key things and questions that you need to ask yourself as a founder before you go into that. And those are the ones we're going to first talk about briefly, and then we can also jump into the 7 key ways of how to raise capital. So those questions that you need to ask yourself, these serve you from a number of things. These serve you from taking a right decision. These serve you for even not looking for money at all. And we're going to go through them very quickly, and then we can go into the 7 ways. Now, the first, you need to ask yourself as a founder, should I even be raising money for this hustle? So you have come up with the idea, you've put the foundation, but then you need to be very clear. Who's your customer, right? What is the problem you're solving for that customer? Who's your competitor? And what investment is required? If you can be able to clearly articulate those things, you might find you are solving a problem, you have the customer, but the competition is too big, it's going to swallow you. So you require a lot of money. You might not be able to do that. And then the other thing as well, if it's a high capital intensive business, do you want to go through that? Is it now? So that's why you need to ask yourself, should I even be raising money for this? And then at times you maybe want to raise money, but you have some money with you yourself that you can be able to, focus and invest in that business. So you need to be very clear on that question. Do I need to be even raising money at this point? The second one, which is important, that you need to also ask yourself is, if I get this money, what am I going to use it for? So you're asking maybe people to give you $10,000. So that $10,000, what is it going to do? You don't want to get money and then you start saying, okay, now I'm going to do this, You need to be very, very clear. If it's, paying staff, buying inventory, for your distribution and marketing, all those things have to be very clear, because anyone who wants to give you their money, they want to be very clear on where the money is going so that they are assured of the returning of that money back, right? So then after having addressed that question of how you're going to use the money, the question is, if you fail to raise money, then what? Okay? Because a number of times you pitch even to the different investor sources, and they don't give you the money, but you have an idea and you believe in it. What do you do, right? So, and many investors ask this question, if you fail to get the money, then what? The reason is they want to understand how passionate you are when it comes to this idea. Because then someone will say, maybe I'll start from small, I'll start from scratch, I'll build it up. And then there are those who will say, no, I'll shut it down. So are you passionate about this idea that if you fail, you're willing to go the extra mile? That's very important to understand properly. Now, having also gone through that, then do you understand your numbers? Do you understand the macros? Do you understand the market? Do you understand the competition? Do you understand the projection, the valuation of your business today and then in the future? Because that's what investors are looking for. They want to understand whether you really know your numbers. Financials and money are the heart of the business, right? Like I said, financials is the heart of the business. The blood of the business is the money, right? So that is very important as well to address as a question when you're a founder who's about to source for money. The other important thing also to know is that what is your appetite for shareholding limit? Because today you have a business idea, maybe you have registered it, you have 100% shareholding. When you're asking for money, some people are going to ask for some shareholding stake. Because if someone comes and say they want 50% stake, are you willing to give them that 50% stake? Because then it will also give you an indication of which investor to eliminate and which investor to go for, right? So you need to understand your appetite of a limit for shareholding. Closely tied to that, the other critical question you need to ask yourself, which level of freedom are you willing to give away? Because when you bring in some investors and they have taken stake, that means you no longer have the liberty to make decisions. The flexibility has reduced, right? So at times you have to consult, you have to go for a board meeting, you have to, get decisions from other people depending on the level of shareholding that you have given away. So what level of freedom are you willing to give away with this money? Just the last one, which is important, is which type of investor are you looking for, okay? And what other additional benefits are you looking to get from this investor? Because some people might just want money, right? I just want money to inject in my business and then I go. Others are looking for maybe a mentor in business. Some others are looking for a distribution channel. Others are looking for networks. Others are looking for contacts, which some investors can bring to the table, right? So depending on what you're looking for, and it will define which type of investor you're looking for you to focus on, having a conversation with. So those case questions are so important and critical to go through before even we discuss the levels and the sources of investment that you should focus on. Those questions, you need to address them. Now, in our messaging section, we'll definitely put a link of those questions so that you can be able to do a check for yourself in your business, whether you actually need to get capital sourcing, but after going through those questions. Now, having put that aside, and we are very clear on what the questions are saying, but let's give a scenario, maybe all the things check out and you say, yes, I meet all these criteria. Now, let's go through the 7 key areas and ways you can raise capital. The first one, which is very important and highly recommended, is called bootstrapping. Now, with bootstrapping is when you use your own money to run and start your business. And this can be from your sources of income. For salary earners, it can be your salary where you get a portion and you start your hustle, or you may be having to break your savings, break your investments. Sometimes you may have to maybe flip an asset. Maybe you have a piece of land or you have a car, and you say, you know what, I need to flip this so that I can start this hustle. Because I believe in it and I'm passionate about it, it will be able to grow and maybe buy back my piece of land as that investment comes back into life. So that is the first level and way of sourcing for funding for your startup. But let me tell you something. This is the most, highly recommended source of, funding for your business. Why? It gives you the freedom, right? Because you are still 100% shareholder of your business. It gives you a chance to test and make mistakes as you're building your business. Then you don't have any leverage from anyone to pay back that money. So you can be able to even stagger your business to grow gradually into what you want to see. So that's why this mode of raising funds is so important and is so recommended to take up. So having gone through that, and we have agreed now bootstrapping is a good one. The second one that you need to consider if you don't have enough funds is friends and family. Now, friends and family, we start with our circles. Like the saying goes, charity begins at home, right? Normally we have some of our friends, some of our family members who have these resources. You have a good idea and you may be limited on the savings that you want to inject in. So you can easily pitch to these people and they can be able to give you money. We have seen it a lot with people like, some communities, the Somali community. We have seen it with the Indian community. They normally do this a lot and they help themselves to grow. That's why some of these economies are growing. We need to start, doing this in the African setting. However, on the flip side, with friends and family, the big only flip side that we have is at times it can break relationships. You go, let me give an example. You have an idea, you go to your uncle, pitch to him this particular solution. He says, okay, good, I'm giving you $10,000 to start this business, but I need it after 1 hour. Unfortunately, the business collapses. You don't have sources of funding to pay back. Now, the uncle is calling you to tell you to pay him back. You're not picking calls. That definitely breaks crack in the family line, right? And then the other thing is, times some of this money, because the people know you, they have given you money, they now want to give you all their ideas. They become the mentors, the coach. They know it all. Those are some of the problems that comes with friend and family. So depending on how your situation is, if you have good relationship with the family members, take a decision and see whether this is also a viable option where you can get some funding to put in your business, to put in your hustle and grow it. But important, you must always be honorable to return that money when the time is right. Number 3, which is also another important aspect and option of sourcing for business, is the startup accelerator hubs and incubation hubs. We have seen a great phenomenon of these coming into the African setting. We have seen quite a number of them in Kenya, in Nigeria, in South Africa, and in Uganda here. We have quite a number of them that have opened up. And these are normally in partnership either with governments of the different African countries, and as well, there's some which are also backed by foundations like MasterCard Foundation with their Young Africa Works. They normally pump in money to support a number of young entrepreneurs who are starting with great ideas, but they don't have capital. Now, this one is a good one. Why? It's good because they first start by skilling you. So before they give you the seed money, they start by polishing you, skilling you, and preparing you for the market before you go out. By the time you go, at least there are some risks that they have waived off you, so that you can be able to navigate the the brutal entrepreneurial world a bit better, right? So it's a good skilling ground, but most of them normally give you seed funding money. And the beautiful thing with this one, some of the monies you don't have to return, right? So they give you seeding where you maybe about $5,000, $10,000, $20,000. We're seeing a number of phenomenons and initiatives for the youth, the women, and other entrepreneurs where they now channeling some money, $5,000, $10,000, $20,000 to support spur the businesses and start off the businesses in this particular setting. So these are very good, opportunities and initiatives. So I encourage a number of our young entrepreneurs to, come up with solutions and make very good use of these incubator hubs. These incubator hubs have been big in the world. We have seen Y Combinator, which is one of the biggest in the world in the US, which has birthed like Airbnb, Stripe, and the other different companies. And these normally have grown to become multi-million-dollar businesses globally. So these are very good options to consider. Venture capitalists and angel investors. Now, with venture capitalists and angel investors, I'll start with the angel investors. Angel investors these are normally people who have made it in life, very rich and well-to-do people. Some of them have even become philanthropists. They normally give charitable foundations. They're like Bill Gates, Tony Elumelu, who's in Nigeria, the chairman of UBA Group. They normally give some of the funding to young starting entrepreneurs so that they can grow their business. But what is most important is some of them also give some of it as seeding money, where you don't have to return. They also do some bit of scaling, but then others will definitely put a return aspect depending on which particular angel investor you're dealing with. But these are very good opportunities. So please look out for these initiatives and opportunities if you're to start up a business. Most of these are very interested in tech-driven businesses, right? So if you're doing a business, look for ways of putting in a tech aspect, and because that helps to give scale, that helps to grow, and solve problems for Africa, solve problems for Uganda. So that's very important to look at. Now, after looking at angel investors, what are venture capitalists? Venture capitalists, these normally are different from angel investors because they come in, first of all, with big monies. Secondly, they normally don't invest in ideas. What they will do, you have to have what you call an MVP, minimum viable product, or they will have to have a POC, what you call a proof of concept, right? So if you have done something, at least you've proven that this works. There is a commercialization aspect, and these are the returns. That's why I said we have to know your numbers. Those normally will invest in you. They normally, in an African setting, maybe you find maybe 50,000, 100,000, $2 million, right? Depending on the idea. So these are very also good sources of funding. We have seen venture capitalists in the US who have funded, like Sequoia Capital, who have funded big-time companies that are right now known to be, global players, right? So these are very good sources of income. What is important to note with venture capitalists, they're very aggressive on the margins, so they will normally push you on shareholding when you come in, so you have to be very smart on which level of shareholding you want to give away. The second one, which is also important to note, is that they're also very important, they are very, very keen on the margins, so they will push you also on the return on investment. So if you're willing to to be pushed to drive business aggressively, this is your source of funders that you need to look at. The other aspect maybe to note is that most venture capitalists, they normally look at divesting between 3 to 5 years. So their approach is that they build to flip, because that's how they make their margin, right? So if you're building a legacy business, right, you want to take over for your children, your grandchildren, maybe they might not be your area of focus. If you're building a business for life, this is what I get my daily income. Those might not be your areas of funding. And if you're looking for a business, that you want to hold for life, I think those are not the ones. But if you're looking for a business to grow, maybe multinational, they can sell their stake, but you retain yours. But you need to be very mindful about venture capitalists if you're going that approach. Okay. So having looked at those, we've looked at the venture capitalists and angel investors. We've looked at the startup incubators. Let's go to number 5, the accessing credit from the standard financial institutions. And these I name banks, these I name microfinances, money lenders, some bit of SACCOs in there. So these are normally, these ones have been around from time memorial. Even in the Bible, lending has been there. So because of that, they are a standard source of funding. I personally have accessed a lot of funding from the banks, and it has worked for me in some of the hustles that I've done. So it's a recommended source of funding. But what is important to note with the banks, with the microfinances, you need to be very careful on about 2-3 things. The first is the interest rate, right? So you need to be able to negotiate an interest rate that really fits within your business. You don't want the bank to wipe you out, both your capital and margin, because the higher the interest rate, the harder it becomes for you to repay back. And then it eats into your margin. So you need to be very, very careful about the interest rate. The second thing is that it's very advisable not to take bridging financing or very short-term lending for starting a business. Let me give an example. You're starting, say, a popcorn store, under $1,000, but you borrow this $1,000 from a money lender who wants it in 1 month. You'll be wiped out, I guarantee you, because the time they have given you to pay back this money is not sustainable. So you need to come up with terms that really fit within your business hustle and even the cycles, because there's some businesses which earn daily, there's some businesses which earn weekly, there's some businesses that earn monthly. So those maybe you can be able to scale the prepayment period come a bit closer. But if I'm into real estate, where I've bought a plot of land and then I've subdivided, I'm flipping. You sell 1 plot a month or in 2 months, and then you want to repay back this loan maybe in a month. It's not going to be sustainable for you to run this particular business. So you need to be very careful on that. The last one maybe what we'll talk about is, as you're negotiating, you need to be looking at the terms that they're giving you as a bank or as a microfinance or as a money lender. Why? Because the type of interest rate that you take also matters. If it's a fixed rate or variable rate, you need to know. Because with a fixed rate, if I take a loan today at maybe 15%, and let's say the interest rates go up and my loan was at fixed rate, I'll stay the same in terms of my repayment. But if it was a variable rate, you know what happens? What will happen is that the loan will move with the interest rate. So if the person who was paying at 15%, maybe you are paying now at 24. That means if I was paying, say, $50 on a monthly, now I'm paying $250. You find that that becomes hard depending on how your cash flow cycles are looking like. So that puts a pressure on your business and you don't want that. So you need to be able to look at the terms that you're taking from this particular source of funding. But it's a very recommended source of funding for anyone who's starting up a hustle. Though maybe last disclaimer on this one, most banks do not lend startups. So what you need to do, either you need to have some security or have a proven record, or you can borrow, if you're a salary earner, you can borrow a salary loan and then get the money and start your hustle, right? So that is important. And the types of loans that you can get from this particular area is either secured loans or unsecured loans. With secured loans, we have seen banks go up as $70,000 unsecured, but then there are those, depending on what you're borrowing, which will be secured, and then you put maybe your house, your land, your car, depending. So it's a good option to look at. So number 6, which is also a recommended source of funding, would be crowdfunding. Now, crowdfunding, what does crowdfunding mean? Crowdfunding is when people pull money together. When people pull money, either 2 or more people pull money together to start a venture. Now, I'll give an example. Say we have seen investment clubs in Uganda and even in South Africa, where people pull money together to start a project. I, for one, actually benefited from this, where we came together with a couple of friends. We bought land, we flipped, we did a farming project together, but it reduces the level of investment you put in. So it reduces your risk. Instead of putting in, say, $5,000, each one is bringing maybe $500. So if there's a loss, let's say, God forbid, at least someone would have lost $5,000, you're losing $500. So it reduces the risk. So crowdfunding is another good option to do. We have seen it in investment clubs, and I recommend it as an option. We have seen it in circles. Kenya, I think, is a good testimony where they have used circles a lot to do a number of projects together where people come together and save together. In Ugandan setting, we had Niginas, right? Where which are called, I think, Mama, those women groups where they put money together to start projects, and they have worked very well. We have seen very good testimonies in this particular area. Then we've seen also partnerships. Whereby I have 2 friends who we have the same idea, we pull money together and we start a project. We have seen joint ventures whereby I have I might be a small company starting up a project, and then I bring another company on board. We share the risk, we share the financial risk as well, and we go into that. The last one maybe, which is also keen to talk about, and this is for major startups. I may be starting up a project, but I'm going to look for funding to pay employees. Whereas I have a friend, maybe it's a digital company where I need an app and someone has a skill set. I'll go talk to them to come and develop that app. But I tell them, instead of me paying you the money and me borrowing money to pay you, why don't I, when we finish the app, you take a stake in my company? So they work for you, but instead of you paying them, they're going to take a stake in the company when the things come to life. There you give them what you call a future convertible note, which means that at the time T, you're giving them a stake. So instead of having gotten maybe $500 for the work they have done, they'll get maybe 10% shareholding in the company. I think that's something very brilliant, because the beautiful thing is that shareholding, if the company starts growing, the person who had 10%, maybe their share value was $500. In maybe 10 years, it may be $50,000. Win-win, right? So that is a very viable option that we can, talk about today. Now, having exhausted number 6, let's go to the number 7, the final one. Now, the final one, which is a good option as well to source funding, would be using retained earnings to grow and start up your business, or what you call diversification. Now I'll explain both of them. Now with retained earnings, if I have like a project today but I want to start up another maybe branch of it, instead of me taking out my profit and I eat it, I just use that money to start the project, right? So in every profitability, I say I'm not going to earn anything from this business. Whatever return I get, I use it to start another maybe branch, or to open up a distribution channel, to increase on its marketing, to be able to hire another person. So that in a way, the business is growing organically. Instead of you throwing in money, you say, no, let it grow organically in there. So I'm not adding in my personal money, but the business, what it's making, I am just throwing it back in to increase maybe the distribution, to increase the network, to hire more staff, to, open up another branch. That is another sustainable way of, raising funds for your business. As a founder, normally it's a tough place to be in. Normally you get paid the last. You don't, after getting all the other people paid. But the other thing is that even you can take a risk and say, I'm not going to even take this money, let me reinvest it back, and I scale my business. Now, having understood retained earnings investment, let's talk about diversification. Now, diversification, I'll give a simple example. I have a saloon business today, which is running very well, and I'm getting some money there. As I'm getting that money, instead of me taking it out as a profit, maybe someone has told me there's a Rolex business that is doing very well. I have proven myself in the saloon business, but I want to diversify a little bit, right? So I get the profit that I got. Instead of me eating it or taking it out, I start the business of Rolex. And that starts growing slowly, and that also scales like that. So instead of me getting money from elsewhere, I grow my empire organically through my already invested money. So that is another way, I think, of growing your business. And I believe this is another sustainable way of growing your business. The benefit with this is that still you don't have to give away your leverage of shareholding, of your decision, of freedom. As a shareholder and as a business owner and founder, you can be able to stay with this, but growing organically. But the other thing as well is that instead of you rushing to grow, it helps you also to grow, gradually as you grow your business. So that is a critical option that you can use to grow your business. Having looked at all those, I believe now we have exhausted. We have talked about the questions. We have talked about the 7 ways of how to raise your capital. So I believe these are very viable options that we can use to grow our businesses. I'll pose a question to you. What do you think we have left out, and what do you think about these options? Please share in the messaging below in our messages. We'll definitely look at them. But what is important is that for the first 2 people who give us their feedback, we'll definitely have some nice business books that we'll send to you. Wherever you are in the world, we'll figure it out. My team is already pondering on how we do it, but I know we'll do it, and we'll reach out to you and deliver those books to you in one way or another. So we thank you very much for listening to us, and we also thank you for subscribing and hitting the like button and the notification. And as I sign out, I say, stay grinding, stay hustling, and keep it Afrobiz.